Sarah, look, I'm bullish on the banking industry, and here's why. This has been a priority for our industry and the federal and state banking regulators for over the past 4 years to prepare for the rising rate environment that we're in. So our banks have been creating a mixed portfolio of variable rates and fixed rates to prepare for this environment that we're in. So the Fed is getting back to what it needs to be for our country of a normal rate environment, which we were, as you know, in a low rate environment for a very long time. This will create liquidity for our banks, Sarah. Our customers will save more money now in an FDIC bank account and have a balance in their own portfolio. So this liquidity will help our banks even raise more capital for more lending, because we believe the economy is strong. We believe reg relief, tax reform has strengthened the economy. And so loan demand is still very high. Consumer confidence is high. So by a rising rate environment, we create more savings, more liquidity for banks. And our banks have been prepared for this, and as well as our banking federal and state regulators for the last 4 years, Sarah.
Matthew, talk to us about how attractive the environment is now for the banks as we approach earnings. Which ones are best suited for this rising rate environment?
Yeah, so my counterpoint here is that the yield curve, the shape of the yield curve matters, the geography in which a bank competes matters, the balance sheet positioning matters. And when you step back and you look at the United States, you say pockets of the Southwest and the Southeast are asset sensitive, meaning they fare better when the Fed funds is going higher, but pockets of the Northeast, particularly in the metro areas like Boston and New York City, where you have liability sensitive institutions, long dated assets, short dated funding, they're seeing NIM compression. And so what they need is a steeper curve and for the Fed to slow down or stop raising rates altogether for improving margins.
But Wilfred, let me say this. Wilfred, look, the Fed needs to normalize the rate environment because a downturn will eventually come in our economy. I think our economy looks really strong now, but a downturn will eventually come. And when it does, Wilfred, we need the Fed to have the tools in its toolkit to lower rates to stimulate the economy then. So what the Fed is doing, and it's a very delicate matter, obviously, they have to be careful because they don't want to put a wet blanket on this economy. But the gradual rate increase that the Fed is doing is the right steps to keep the economy strong and not put cold water on it. But we need to get back to normalized rates for our country, Wilfred.
Yeah, which we're on a path of doing quite significantly more so than a lot of the other developed nations. Matthew, let's dive into some of the stock picks. You mentioned geography matters, structure of the balance sheet matters. So of the big banks, who is set up best for the current environment?
Yeah, on my list in the Northeast, I like Sterling Bancorp. This is a $30 billion New York City institution. We expect the core margin to be sustainable, flat here for the time being as they reposition the balance sheet. They have some thrifty assets that are turning into commercial assets, so they're becoming more asset sensitive, and I expect them to do well on the margin front and the profitability front. And I think that stock is pretty attractive here at 10 times earnings. On the opposite side, we remain underweight in New York Community. Ticker there is NYCB. They have an elevated loan-to-deposit ratio. The cost of funds is moving markedly higher. And in the primary asset class in which they compete, New York City multifamily, the spreads there have been razor thin. It's been a super competitive asset class, and so I expect to see quite a bit more margin compression over the next 12 months.